Okay, let's go ahead and talk about what's referred to as constructive retirement. Just as a reminder, when one firm sells bonds directly to a related party, the consolidation process is very simple. The lender and borrower have the same amount of interest, revenue, and expense, assuming they're both using either straight line or the effective interest method, and both have the same amount of asset or liability. We simply close one against another. From a consolidated standpoint, the debt never existed. It was never issued to an external economic agent. It's much different when one firm buys the debt of the related firm on the open market. So for example, let's assume that Big owns 100% of Little, and that in 2002, Big issues $100,000 of 10% 10-year bonds at 98. So they've got a liability bonds payable, and they're paying interest over time. A few years later, Little buys these bonds on the open market at 103. Now, individually, Big still has bonds payable and interest expense on their books, while Little has an investment in bonds and interest revenue on their books. But from a consolidated standpoint, the consolidated entity has just repurchased and retired its debt. So that's why this is referred to as a constructive retirement. The consolidated entity should therefore have a gain or loss in retirement, and as part of our consolidation process, we're going to need to go ahead and get rid of the bond payable liability, get rid of the investment in bonds, get rid of the intercompany interest, and record a gain or loss on retirement. And again, as in other cases, we're going to have to continue doing this year after year. Let's go ahead and go through this example. Again, we're going to assume that Big owns 100% of Little, and that on January 1st, 2002, Big issues $100,000 of 10% 10-year bonds at 98, and they're going to use straight line amortization. So there's a $2,000 discount being amortized over 10 years, or $200 per year. On December 31st, 2006, Little buys these bonds on the open market at 103. Now these bonds have been outstanding for 5 years, 2002, 3, 4, 5, and 6. And so they've got 5 years left to run. And so Little bought these bonds at a $3,000 premium. That $3,000 premium will be amortized over 5 years at the rate of $600 per year. Now first, let's go ahead and compute the gain or loss on retirement. The book value of the debt as of the date of purchase, we have bonds payable, face value of $100,000. That discount of $2,000 has been half amortized. Again, it's being amortized at the rate of $200 per year. For 5 years, $1,000 has been written off. There's $1,000 left. And so the book value of these bonds is $99,000. They were repurchased, or they were purchased by the related party for $103,000, and so there's going to be a loss on retirement of $4,000. This means that on the 2006 consolidated income statement, we have to treat this bond as having been retired at a $4,000 loss. Now, the loss is realized but unrecognized on Big and Little's books. This is in contrast to the case we had for our other intercompany transactions. In the case of intercompany inventory sales or intercompany sales of long-lived assets, we had gains which had been recognized by either Big or Little, but which were unrealized, and our job was to remove that unrealized gain or loss. Now we're in the opposite position. This gain or loss, or in this case a loss, has been realized by the consolidated entity, but it hasn't been reported by either Big or Little. So we're going to need to put this loss on the consolidated income statement. Now this loss is going to be recognized by Big and Little through their combined net interest revenue and interest expense. We'll discuss that a little bit later. Now, in doing the elimination entries, a very useful thing to do is to go ahead and make a list of all of the accounts related to this bond issue on the books of both parties as of the end of the year. So on Big's books, again, Big was the issuer. They've got bonds payable of $100,000. They've got a remaining discount of $1,000, and they have interest expense of $10,200. That's the $10,000 coupon payment. Again, these were 10% bonds, plus the $200 amortization of the discount. Over on Little's books, they've got their $103,000 investment in bonds. Little doesn't have any interest revenue this year because they just bought the bonds on December 31st. Okay, again, here is our shopping list of the various accounts on both companies' books. Now, for the elimination entry, we're going to have to eliminate the intercompany asset and liability and any intercompany interest. Now, there is no intercompany interest in this case, in this year, 2006. The $10,200 of interest expense that Big incurred was incurred during 2006 when the unrelated party owned the bonds. There was no interest expense or interest revenue between Big and Little. Again, Little didn't buy the bonds until December 31st, so there was no intercompany interest over the course of the year. Now, we're going to go ahead and post our elimination entry, and basically we're going to go through our list of accounts that Big and Little have and eliminate them. So we need to eliminate the bonds payable. Next, we have the discount on bonds. We have to eliminate that. Then jumping down to Little's side, they've got a $103,000 investment in bonds, and we have to eliminate that. Now, this entry obviously doesn't balance. We have $104,000 on the credit side, $100,000 on the debit side. The missing $4,000 is the loss on retirement of bonds. Now, as I indicated earlier, this loss is realized but unrecognized on Big and Little's books. It gets recognized by Big and Little individually via their different interest expense and interest revenue over the life of the bonds. So Big's interest expense, again, they've got their $10,000 of coupon interest plus their $200 of annual discount amortization, so their total interest expense is $10,200 per year. Little's interest revenue, they've got $10,000 of coupon interest, less their $600 of premium amortization, for a total interest revenue of $9,400 per year. So the two firms combined have net interest expense of $800. Again, Big has $10,200 of interest expense, Little has $9,400 of interest revenue, which nets out to $800 of expense. Now we can interpret this as Big and Little together or combined recognizing $800 of the loss every year through their disparate interest revenue and interest expense. Okay, let's go ahead and go on to the second year now. And again, it can be very useful to go ahead and make a list of all of the accounts related to this intercompany bond issue on the books of both parties. So again, Big the issuer still has $100,000 of bonds payable. Their discount on bonds is being amortized. It's now down to $800. Recall that last year it was $1,000, and it's being amortized at the rate of $200 per year. And their interest expense is again $10,200. Recall that for simplicity, we assumed straight line amortization, so that'll be $10,200 per year each year until the bonds mature. Over on Little's side, their investment in bonds is now down to $102,400. Recall that they paid $103,000, and that $3,000 premium is being amortized over the remaining 5 years of the bond's life at $600 per year. So $103,000 less the $600 of amortization is now down to $102,400, and their interest revenue is again $9,400. Now let's go ahead and go through the elimination entry. Again, we're going to go through this shopping list of the various accounts that both parties have, and we're simply going to eliminate all of those accounts. So let's go ahead and eliminate Big's accounts, the bonds payable, the discount on bonds, and the interest expense. Now on Little's side, we have to eliminate the investment in bonds and the interest revenue. Now again, this entry doesn't balance. Now obviously this elimination entry doesn't balance yet. Let's go ahead and consider the $4,000 loss that we had here. Again, that loss was realized but unrecognized. So we made it appear on the consolidated income statement through our elimination entries last year, but it did not appear on the income statements of the individual companies. So we're carrying forward that loss. Now, whenever we carried forward unrealized or unrecognized losses previously, we always faced two questions. First, is this an upstream or a downstream transaction? Now, traditionally, the decision whether to consider it upstream or downstream was based on who was the bond issuer. If the parent is the bond issuer, we view this as a downstream transaction. If the subsidiary is the bond issuer, we view it as an upstream transaction. So in this case, BIG was the issuer, so this is a downstream transaction, which means that the non-controlling interest is not going to be involved. The second question was, does the parent use the full or the partial equity method? Let's go ahead and assume that the parent, BIG, uses the full equity method, so they adjusted their investment income to recognize that loss last year. So that means that their retained earnings is stated correctly, and instead we need to adjust the investment in little account. Okay, that's just a rewriting of the elimination entry that we just did, and let's go ahead and think about how this is going to carry forward to the following year. Now, in the entry above, we've carried forward the realized but unrecognized loss of $4,000 by debiting the investment in little account. At the same time, $800 of that is being recognized between BIG and Little's combined interest revenue and interest expense. Again, BIG is recording interest expense of $10,200, Little is reporting interest revenue of $9,400, so together combined they have $800 of net interest expense. So that means that of the $4,000 that was previously unrecognized, last year we ended up actually recognizing $800 of that, which means we only have $3,200 to carry forward to the following year. Now let's see how that elimination entry up at the top for 2007 flows through to 2008. First, the bonds payable. I'm just going to copy line for line from the top entry to the bottom. Bonds payable is still $100,000, the face value. Interest revenue is still $9,400. Again, we're using straight line amortization, so it'll be very simple. That'll be the same each and every year. Let's skip over the carry forward of the realized but unrecognized loss for a moment and jump down to interest expense. That too will be the same as last year because, again, straight line amortization. The discount on bonds is now down to $600. Last year was $800. It's being amortized at the rate of $200 per year, so it's down to $600. Likewise, the investment in bonds is down to $101,800. Again, last year was $102,400. Amortized $600. It's down to $101,800. To make this balance, we need that $3,200 debit to the investment in Little. Again, we're carrying forward $3,200 of realized but unrecognized loss. At the same time in this year, Big and Little together are recognizing $800 of that loss via their net interest expense.